The S&P 500 has dropped more than 20% at least a dozen times in the last century. And every single time, someone on social media declared it the crash that finally breaks everything. Right now, that noise is louder than it's been in years. Now, if you're sitting there thinking, I don't know if I should keep putting money in, pull back, or just wait until things settle down, you're not alone. That question is sitting in the back of every commission earner's head right now, especially when a slow month hits at the same time the market is bleeding red. Here's what nobody's telling you. A crash isn't the thing that wrecks most people. The panic response to a crash is. The guy who stops his Roth IRA contributions in February because the market looks scary, then waits until things feel stable again, doesn't miss the crash. He misses the recovery. And on commission income, where the investing window is already narrow, that timing mistake costs more than anything else does. Most people either ignore the question entirely and hope it works out, or they let their fear freeze them completely. Neither one is a plan. And if you're on commission with no employer match, no automatic payroll deduction, and no cushion between a slow month and a missed contribution, you can't afford to just wing it. By the end of this video, you'll know whether a major crash is actually likely right now, what the historical pattern says about what comes next, and exactly how I position a commission income portfolio to survive the drop and catch the bounce without guessing. Now, I've watched what market fear does to guys on variable income. The ones who came out ahead weren't the ones who predicted the crash. They were the ones who had a structure in place before it hit, so the emotion never got a vote. Now, I spent years as a financial advisor, and I've been on commission income myself. I've been on both sides from the inside out. So let's get into it, starting with the honest answer to the question, is a crash actually inevitable? Short answer, yes. A significant market correction is inevitable. That's not a prediction, that's just history. The market has corrected more than 10% dozens of times in the last 100 years. It's corrected more than 20% more than a dozen times. Every single one of those corrections felt in that moment like the one that wouldn't come back. Every single one made a comeback. The honest answer to is a crash coming is eventually yes, always. The market doesn't move in a straight line. It never has. The question that actually matters isn't whether a correction is coming, it's whether you're positioned to survive it without making the one decision that turns a temporary drop into a permanent loss. Here's what the historical pattern actually shows. After every major correction in modern market history, the recovery has come. Sometimes fast, sometimes slow, but it has come. The guys who locked in their losses by selling at the bottom didn't get to participate in what came after. The guys who held, or better yet, kept buying through the drop, came out the other side in a position they couldn't have built any other way. The mistake most people make at this point is treating the question, will there be a crash, as the same question as, should I do anything differently right now? Those are two completely different questions. One is about market prediction, which nobody gets right consistently. The other is about your own structure, which you actually control. The crash isn't the variable. Your behavior when the market drops 15% in 6 weeks is the variable. That's what this whole conversation is actually about. Here's the part nobody talks about when they discuss market crashes and staying the course. Staying the course is psychologically easier when you have a stable salary, an automatic payroll deduction going into a 401k, and a paycheck that doesn't change based on how many deals you close a month. The advice to just keep investing and don't look at it was designed for salaried employees with predictable income. You're not that person. You're on commission. Your income comes in lumps. You might pull 28 grand in 1 month and 4 grand the next. When the market drops 15% at the same time your pipeline goes quiet, you're not facing one problem. You're facing two at once. And when you're facing two problems at once, the one that feels most urgent wins. The market drop is visible and scary. The pipeline problem is immediate and personal. The Roth IRA contribution is the first thing that goes. That's not weakness. That's a structural problem disguised as willpower problem. The salaried guy doesn't have to make a conscious decision to keep investing. It happens automatically. You have to make that decision actively every single time in the middle of whatever else is happening in your life. When the market looks ugly and your phone isn't ringing, that decision gets harder fast. Now, I've watched this play out with guys on variable income. The ones who got hurt the worst in past corrections weren't the ones who had the most money in the market. They were the ones who had no structure around when they invested, how much they invested, and what triggered them to stop. When the fear hit, they had no predetermined answer, so they improvised. And improvised financial decisions made in the middle of fear always go the same direction. Now, if that's landing for you, that's the whole point to this channel. Subscribe so you don't miss the next breakdown on building an investing structure that holds up when your income doesn't. Now, let's talk about what that structure actually looks like. It's all about the sequence. There's a concept in financial planning called sequence of returns risk. It's usually talked about in the context of retirement, but applies to commission earners in a way most people haven't thought through. Here's the basic idea. The order in which market returns happen matters, not just the average. If you're withdrawing from a portfolio in retirement and the market drops hard in your first 2 years, you sell shares at the bottom to cover your expenses. Those shares don't get to participate in the recovery. The sequence of the bad years at the beginning does more damage than the same bad years later would have. For a commission earner, the parallel works differently, but the damage is similar. If you're forced to stop investing during a down market because your income dried up at the same time, you miss the recovery contributions. You don't just lose the value of the drop. You lose the compounding on the shares you would have bought cheap at exactly the moment they were on sale. That's the real cost, and it's invisible. You'll never see a line item that says money you didn't make because you stopped buying in February. The mistake most guys make here is thinking the solution is to predict the crash and get out before it happens. That's not the solution. That's market timing. And market timing is a game that even professional fund managers with teams of analysts and decades of data don't win consistently. You're not going to win it either, and you shouldn't try. The actual solution is to build a structure around your investing before the fear shows up, so the fear doesn't get to make the call. That means knowing exactly what your investing floor is, the minimum contribution you make regardless of what the market is doing or how the month went. It means having enough cash buffer in your accounts that a slow month doesn't force you to stop investing just to cover rent. And it means having a predetermined answer to the question, what do I do when the market drops 20%? Written down before it happens, not improvised in the moment when your stomach is turning. The crash is coming eventually. You already know that. The question is whether you've built a structure that takes the emotion out of the decision before the crash arrives. Because once it arrives, you're not making rational decisions. You're making emotional decisions. And emotional decisions in the market are almost always wrong. Now, let me be direct about what I do if I were a commission earner looking at today's market noise and trying to figure out how to position. First, I get honest about my cash buffer, not my investment balance, my cash, the money sitting in an account that isn't in the market. If a slow month hit tomorrow and my commission check came in at half of what I expected, how many months could I cover my bills without touching my investments and without going into debt? If the answer is less than 2 months, that's the first thing I'd fix. Not because a crash is definitely coming, because a slow month is always coming on commission, and having to sell investments to cover rent is the most expensive way to survive a dry stretch. And I spent years as a financial advisor, and I built the fee system while on commission income myself. The thing I saw consistently was this. The sales rep who held up through market volatility weren't the ones with the most sophisticated portfolios. They were the ones with enough cash buffer that the market's behavior was genuinely irrelevant to their monthly survival. When you don't need to touch your investments to pay your bills, you can actually let them ride. When you do need to touch them, you don't have a choice. Second, I get clear on my actual investing structure. When do I invest? How much? What triggers a contribution and what doesn't? If the answer is whenever I have extra money at the end of the month, that's not a structure, that's a wish. Extra money at the end of the month is the first thing that disappears when the market looks scary or the pipeline looks thin. You need a predetermined rule, not a feeling. Third, I'd stop watching the daily numbers. I mean that practically, not philosophically. The daily market moves are noise. They're not information you can act on in a way that improves your long-term position. What they are is emotional input that makes you feel like you should do something. And doing something in response to daily market noise is almost never the right call. The guys who came out ahead in every market correction I've watched weren't the ones with the best market intelligence. They were the ones who had a structure, trusted it, and didn't let the noise override it. Here's what the combination of those three things made possible for me. When I was paying off my $175,000 mortgage in 16 months on commission income, the market had rough stretches in there. I wasn't watching the tickers. I had a structure that told me exactly what went where when a commission check landed. The market's behavior in any given week was irrelevant to the plan because the plan didn't depend on the market behaving well. Your math will look different from mine. Your income, your debt, your timeline are all different, but the structure that removes the emotion from the decision is the same. A crash is inevitable eventually. Your panic response is not. That's the only thing in this whole equation that you actually control. Hey Roof Money Pros, if this breakdown gave you something to think about, be sure you hit subscribe. I drop new videos every week on personal cash flow management with commission income and building real wealth and roofing sales. And if you want the system I use to structure every commission check so a slow month or bad market week doesn't force a bad decision, grab the free Feast or Famine Survival Guide at the link below. Thanks for watching, and in the meantime, keep stacking, keep building, and I'll see you in the next one.